let's see if we can make this a super short, super simple example of calculating the weighted average cost of capital for a corporation. Big picture, the concept is it would make no sense for me to borrow money at 5%, go down to the bank and stick it in a money market account for 2%, and consider that my business model. I can't invest in assets over here that don't earn at least what my money costs me on the right-hand side of the balance sheet. So we have to figure out what our money costs us on the right-hand side of our balance sheet, and we want to look at that after tax. Remember, interest is tax deductible. So let's pretend this company has $20 million of bonds outstanding. Some are due within a year, some are due 20 years from now. The company also has outstanding 5% preferred stock, $5 million worth of it, with a $100 par. In other words, we're saying to the world, we're going to do our best if you buy one share to pay you $5 every year. And lastly, the company has common stock, $25 million. That's both the par value and additional paid-in capital with a dollar par value. First thing is we have to use market rates. These bonds may have been issued 20 years ago. These bonds may have been issued 5 years ago. So we don't know if we went out to borrow money today, how much we would have to pay in interest. But we can go out and look in the bond market and see what these bonds here are trading for. And that'll give us a good idea of the required interest rate that bond purchasers would require if we were to sell bonds today. So we checked Yahoo, we checked the Wall Street Journal, and we discovered that these bonds, these 20-year bonds, are not selling at face value. Each $1,000 bond is selling for $934.52. So what is the yield to maturity? What is the required rate that bondholders need to buy our bonds today? So 40 is the N. Why is it 40? 20-year bonds, you get 2 checks every year, semi-annual payments. 20 times 2 is 40. We're going to solve for the I. That's what we're trying to figure out. The PV is the price that people would pay today to buy these bonds. So that's $934.52 is the present value. That's what we learned when we looked at Yahoo. The payment is 20. Why 20? It's a 4% bond, so that's $40 a year. Divide that in half because we pay interest twice a year, and you get 20. And you get the $1,000 face value at the end. Then we compute I, and we discover that the interest rate per year is 2.25. We multiply that times 2, and we discover that the annual rate of interest that people would require to buy our bonds if we were to issue them today would be 4.5%. And remember that interest is tax deductible. Every dollar of interest we pay reduces our income tax bill. So let's pretend like we're in the 40% tax bracket. To change that 4.5 pre-tax rate to an after-tax rate, we multiply it times 1 minus the tax rate. 1 minus 0.4 is 0.6. So 4.5 times 0.6 equals 2.7. So that is our after-tax cost of debt if we were to go out today and issue new bonds to finance new projects. Okay, now let's turn our attention to the preferred stock. Evidently, when we sold this preferred stock, people thought a 5% return was a fair return on their investment. But that may have been 15 years ago, may have been 15 months ago. We don't know what kind of return they would require today. But we know that they're getting $5 a year for every share they buy. Let's find out what they're selling for. So we go out into the marketplace and we see, either on Yahoo or Google or Wall Street Journal, that these shares are selling for $74.63. So their return is $5 a year, and their investment is $74.63. So we're going to divide that by 74.63, and we're going to discover that investors require a 6.7% return on that preferred stock. So if we had to issue preferred stock today to finance a new project, we'd have to have a coupon on it of 6.7%. And the last component is the slipperiest one of all, because as you can see, there ain't no percentage attached to the common stock. So we don't have a starting place, except that we know that this is a riskier investment. And since there's a risk-reward trade-off, we know that this stuff must be more expensive to us than our debt. And we also know that dividends, which is what we're going to pay these guys, are not tax deductible. So the first one is just a wild ass guess. You say, let's add 700 basis points. So 2.7 plus 700 basis points would take us up to, say, 9.7 as our guess for what common stock costs us. Another way to do it might be to say, well, there's a required return that our investors need. And we know from our formula that the next dividend divided by the price of the stock now plus the anticipated growth rate in the dividend should give us the required return that investors need. And if we don't get that required return, they'll sell our stock. So let's pretend like our stock currently is trading for 20 bucks. The dividend is currently $1.78, and we think that the market thinks it's going to grow at 1%. So if the current dividend is $1.78, and we think the market thinks it's going to grow by 1%, multiply that number times 1.01, that'll tell us that the next dividend will be $1.80. And then if the current trading price of the shares is 20 bucks, we'll divide that number by 20, and then we'll add the growth rate, which is 0.01 plus 0.01. And that gives us our guesstimate of what our common stock costs us. The other way to do it might be to look at the capital asset pricing model. So let's pretend like the risk-free rate is 2% and the premium to invest in the stock market as a whole is 8%. So we take the 2% risk-free rate plus the beta of our stock, and let's say our beta trades just like the stock market, so it's beta 1. So 2% plus 1 times 8% gives us a cost of 10%. So now that we know the estimated costs of our components, we can do the weighting. 40% of our money, remember here's 20 million out of a total of 50 million. 40% of our money costs us 2.7% after tax. 10% of our money costs us 6.7, and 50% of money costs us 10%. Remember, we didn't have to change these for tax effects because dividends are not tax deductible. So when you do that arithmetic, you discover that our weighted average cost of capital is 6.75%. So we need to invest in projects that earn more than 6.75%. Now we could make it more complicated. We could include flotation costs. In other words, if we issued new stock, how much would it cost us to do that? If we had to issue new bonds, how much would it cost us to do that? We also might look at the optimum capital structure instead of our existing capital structure. Maybe we should have more debt, or maybe we should have more equity. But those are complications for your next finance class. For now, I just hope you get the concept that we're trying to find out what our money costs us on the right-hand side of the balance sheet so we can invest in the right projects on the left-hand side of the balance sheet.